Investors, bonjour, this is Mike Héroux, founder of Dividend Stocks Rocks and passionate investor. Today, we are answering a question from our YouTube subscribers, F. Seri, that asked me, what's going to happen with the market in the upcoming months? Should I sell because I'm up by like 40%, making a lot of money, and now I'm thinking, yeah, maybe it's time to cash out part of my profit, secure my portfolio, and wait for the next storm to hit. And this is a common theme that we have as an investor, especially if you're an individual investor managing your portfolio. You look at your returns, you feel good about it, and then you keep asking yourself the same question: is it time for me to secure part of my profit and put that aside? So we're tackling this topic today. You already know by now that my answer will be just stay invested and focus on your plan. But now let's go back in time and see what actually happened in the past 5-6 years and how we could have managed this, and a few reasons why it is tempted to sell, but you should never do it. So now let's go back all the way back to 2015, and let's try to find the best reason for not invest on that year. Kind of funny, in 2015, CNBC called that it was the hardest year to make money in the past 78 years. That's kind of crazy, right? The point was that it's not a huge bear market. It's not that investor lost a bunch of money, but the problem was, if you look at any type of asset classes, they were all pretty much going sideways. They were not generating anything that was like commodities, equities, bonds, gold, name it. It was just a bad year to try to make something up. Then in 2016, the Brexit comes in. The threat that actually eventually happened, that you see the UK getting out of the Eurozone, created a huge market drop, and then it's kind of normal. We were running a bull market between 2009 and 2016, and now you said, well, last year was a bad year to invest. It went a bit sideways. That was very hard to make profit. And then this year we have major bad news. Not necessarily bad news, but major uncertainties. And if there's one thing the market hates, it's uncertainty. Keep in mind that the global market is trying to price whatever assets today for the future. So when you have lots of uncertainty, well, it makes all the calculation go bogus, and it's very hard. And this is why usually the market drops. So now it leaves us to 2017, where there's a lot of technical signals calling for the dreaded Hindenburg omen. And if you don't know what the Hindenburg omen is, it's not really important, to be honest. Let's just say it's a bunch of technical signals that once you combine all of them together, it clearly sends a message that, you know what, a major crash is happening. It's about to happen in the next few months or next few years, but that's for sure. All the technical signals are telling us this is what's going to happen. And then 2018 happens. Worst year in the past decade to invest your money. We finally had that bear market. Look, all those Bears lovers are dancing and singing, and they all find it very happy because they are finally there to say, I told you so. So now you're in December 2018, and a lot of people say, you know what, 2019 is going to be a mess. And wow, surprise, it didn't happen that way. Actually, 2019 happened to be the best year to invest in the past decade. And I'm going to skip over 2020. We have talked about it so much, but you know what? We pretty much had everything there. So a bear market, a recovery, a Great Depression, a VKW recovery, name it. It just like we had a lot of fun. So that brings us to 2021. And then a lot of investors are still thinking, well, you know, when I look at what happens over the past 5 years, we had a great run. The S&P 500 almost doubled in value. The TSX is up by like 43% for the past 5 years. It's probably time to retire a part of my portfolio just to secure everything and then avoid the next crash. Because let's be honest, the problem is not that we look at this graph and we say, oh, we're very mad that we're making money. The problem is we are afraid that we live through another 2008 again. 2008 financial crisis, the market went down by like roughly 30% in like 2-3 months. We had the same thing with the pandemic within 3 weeks, actually. So it's got kind of like pretty scary. But overall, what we don't want to see here is to see our portfolio reaching $1 million and then losing $300,000 within a few months. That would make us panic. When this happens, here's my first trick. I don't actually look at my portfolio value, but I rather look at the dividend payments. I've picked a few examples, just classic names: Johnson & Johnson, Procter & Gamble, Fortis, and National Bank on the Canadian side. That was between 2008 and 2012. That was pretty much the time that you needed to recover from that market crisis, about 4 years. And during that time, the first 3 names increased their dividend year after year without even budging. So basically just telling you, you know what? The market may tell you it's a catastrophe, but my business is running well and I still make money, and I'm even able to increase my dividend every year. I've especially selected National Bank. I could have picked any other Canadian banks, but I wanted to show you that even when there's a financial crisis hitting banks, if you pick those that are well diversified and a solid environment like what we had in Canada for banking, for example, they still are able to increase their dividend. National Bank was the first one to start increasing its dividend again among the big banks in Canada. All the others followed. The last one was BMO in 2012, but just to say that they pretty much recovered what they were losing in terms of putting their dividend growth on pause for 2 years. And just the fact that you're getting a pay raise year after year should be enough to smoother things a little bit. But the problem I see here is too many investors just focus on those very small period where they're losing money. It's a few months, it's a few years. If you count the recovery, sometimes even during the tech bubble, it took about like 6 years to fully recover. And then right away we had the financial crisis right after that, and it was pretty much a lost decade for a lot of investors. But then you have to look at the larger picture. You're not investing for 3 months. You're not even investing for 5 years. You're going to likely invest for 30 to 40 to maybe 50 years. So if you start in your 30s and then you pass away in your 80s, that's 50 years of investment. So why would you focus on the couple of years? That just doesn't make sense. On this graph, you see 21 years of investment for both the red line is the S&P 500, the black line is the TSX. You have in early 2000 the tech bubble followed by the World Trade Center. That was a catastrophic period, and right above the moment that we were about to breathe a little bit, then boom, financial crisis hit. Take another hit. We're back still to 2001 levels. We haven't made money in almost 1 decade, which is kind of like disgusting. Now you recover a little bit. There's the oil bust that greatly affected the Canadian market because you know how we're structured for our economy. A lot of it is based on natural resources. And then we had the quick bear in 2018 that didn't affect too much because it was just like V recovery. And then we have another V recovery on the market with the C word pandemic. I'm not going to talk about it today because I'm kind of pretty much upset about this whole thing and I don't want to hear about it anymore, but still we have to live in it. What I want to show you here is even though I started this graph right before the tech bubble exploded, we have 21 years and the annual growth rate is between 6 to 6.5%. So if you have stick to the plan and just completely ignored market events and you stick to your portfolio, chances are that you are on track with your plan. And that's another thing. If you plan for a return of like 8% or 10%, you're just dreaming. This is not likely going to happen and you have to be very careful about the dates. Speaking of which, I want to show you this because I found it like very interesting. If you just take out the tech bubble and the World Trade Center out of the equation, suddenly instead of getting close to 250, 300% total return for the past 21 years, you take 3 years off and then you're at 500 and 336 for the TSX. So just to show you that a lot of people can show you a graph, and if they want to make you invest in gold or make you invest in bonds or make you sell your stocks, they're going to show you like graph that are starting right before a bubble, because then you'll see more protective assets or assets that will thrive on fear. They will do well. But if you just play around the numbers a little bit and then you just play with the dates for 2-3 years, you have a whole different story. So which graph is going to be for the next 20 years? You know what? That will be something between this one and the last one. So I'm not telling you should expect for more than 6 to 7% yield in terms of return for your plan. I'm saying actually that you should have a plan. The problem here is a lot of people are chasing returns, which I get it when you're looking at your portfolio every day or every quarter and then you're just like, oh yeah, I'm up like 40% versus last year, but it's probably time to cash some profit. But what happens if you cash your profit and the stock market is going up for another 5 years? Because you know what? There's a lot of people saying that it's all going to crash, but there's also great positivity that are going through the market right now. You have companies that are thriving. You have very strong dividend growers. I've looked at my portfolio, and you know what? Regardless of the oil bust or the bear market of 2018 or the COVID pandemic crash last year, most of my companies increase their dividend nonetheless, and they keep thriving and they eventually recover, because you know what? Companies that shows strong dividend growth are likely going to survive those crises and they're going to thrive in the future. When you think about it, it only makes sense. Dividend growers will have a lot of cash flow generation ability. They usually have a robust balance sheet, and it's pretty much what you need when you're going through a recession. So instead of waiting for the next bear crash and then sell a bit and then go in, go out and try to time the market, why don't you set up a real plan, focus on having a 6 to 7% yield if you're 100% equities. Obviously, if you're more conservative, then you have to decrease your expected returns. But once you follow that, those crises will be included in your plan, so you don't have to worry about them. A lot of investors will tell me, yeah, Mike, that's easy for you to say. You're in your late 30s, so you have like plenty of time in front of you, so most likely 30 to 40 years to invest. So you don't have to care about what's going to happen next in the next 5 years, but I'm about to retire, or I'm retired already, and now I'm scared to lose 30% of my portfolio. For those investors, what I would have to say is the day that I'm going to retire, I will have between 12 to 24 months in cash. That is like basically my retirement budget. I'll calculate it, and I want to have 1 to 2 years in cash and then use the dividend to boost that cash account all the time as I am withdrawing money. This will give me enough time to just wait until the crash happens and then the stock portfolio recover, and then I can sell a few shares if needed be. But in the meantime, I'll be sitting on my cash. I'll be enjoying my life, going to a restaurant, go golfing or running, whatever, and I don't have to worry about the next recession or the next market crash. And I think that once you get to retirement, you can secure that part of your portfolio, and for the rest of it, let it run. Follow your plan, and it should work very well. So I hope that you have enjoyed this video. I hope that it's given you some perspective. Personally, I'm staying 100% invested in equities. I've been doing that since 2003. So I've went through a couple of market crash already, and I intend to do the same thing going forward. And I don't see the problem, because I believe that offense is the best defense. And by acquiring productive assets will help me to go through any kind of curveballs the market is going to throw at me. So please give me a like button, follow me on YouTube, subscribe to my channel, and until the next video, stay invested.